All right, let's dive into something pretty wild today. We're going to unpack a theory floating around the silver market that is, frankly, mind-bending. It suggests all the chaos we've been seeing, well, it might not be chaos at all. It might just be the final act of a very, very long game.
So you have to ask, what's at the heart of this whole theory? It's JP Morgan's absolutely massive stockpile of physical silver. But the argument here is that this isn't some boring long-term investment. No, it's being framed as ammunition, a weapon, just waiting to be fired as part of a very specific three-act play.
And that really gets you thinking, doesn't it? What if the shortages, the crazy price swings, that feeling of panic in the air, what if it isn't just random market noise? What if it's all being carefully choreographed, building towards one single explosive moment?
Okay, to really wrap our heads around this, we need to set the scene. The whole theory climaxes in a specific scenario, a specific time, December 2025. And the picture it paints is a market that has gone into absolute meltdown.
Now, according to this theory, you see silver at $64 an ounce, and you might think, wow, bull market. But that's not the story here. This isn't a sign of health. It's a fever spike. It's a symptom that the whole system is breaking, that the trust between a physical ounce of silver and a paper contract that says you own an ounce has totally shattered. This is pure panic.
So you gotta ask, where's the proof? What evidence does the theory point to for this kind of breakdown? Well, it zeroes in on a few key data points that suggest there are some deep cracks forming in the market's very foundation. First up, you've got this wild disconnect at the Comex. I mean, look at this. For every 100 ounces of actual, physical, registered silver sitting in the vaults, there are paper contracts out there laying claim to 244 ounces. It's basically a giant game of musical chairs, where there are more than double the players than there are chairs. You just know that's not going to end well.
And the stress isn't just on paper. This number right here, 30%, that's the annualized lease rate. That's the interest someone is willing to pay just to borrow physical silver. A rate like 30% isn't just a sign of scarcity. The theory argues this is a sign of extreme, bone-deep, desperate scarcity.
And look, this problem didn't just pop up overnight. It's been building for years. Since 2021, the cumulative supply deficit, the gap between what we use and what we mine, has supposedly ballooned to 800 million ounces. This is presented as the foundational crack, the structural failure that the whole crisis is built on.
So if the market is spiraling into chaos, you have to wonder, who's in the best position to take advantage of it? Well, this theory points its finger directly at one institution that has a very colorful history with these exact market mechanics.
The theory uses this history as critical context. We're talking about 8 years where their traders were convicted of spoofing, placing huge fake orders just to shove prices around, and it all ended with a nearly $1 billion fine and an admission of guilt. So the argument here is they aren't just passive investors watching this happen, they're active architects who know exactly which levers to pull.
So how is the stage supposedly set for this whole event? How do you orchestrate something on this scale? Well, according to the theory, it all went down in two very distinct phases. It's laid out as a classic 1-2 punch, super effective. Phase 1 is all about getting your hands on the real stuff, the physical asset, and doing it on the cheap, under conditions you helped create. Then comes phase 2. You just let go. You take your foot off the brake and let the market's natural forces, which had been held back for so long, finally go absolutely wild.
And this is where it gets really interesting. The theory directly connects that market manipulation, the stuff they were fined for, to phase 1. The argument is that by pushing down the paper price, they were able to quietly suck up a colossal amount of physical silver. We're talking over 750 million ounces at prices that were completely artificial.
And that brings us to phase 2. So they've built this massive physical position. Now the theory claims they switch tactics. By October 2025, they get out of their huge paper short positions. They basically remove the anchor that's been holding the price down, and then they just sit back and ride the wave. That massive supply deficit, projected to be 149 million ounces this year alone, does the rest, sending the value of their holdings to the moon.
But wait a second. That leads to the biggest question of all, doesn't it? If they are making an absolute fortune as the price screams higher and higher, why on earth would they ever want it to stop? Why is this historic, epic price run not the end of the story, but actually a trap?
Because, and here's the twist, According to this whole narrative, the peak price isn't the goal. It's the exit ramp. This moment of maximum hype, when everyone is piling in, supposedly creates the absolute perfect conditions to execute the final move, what the theory calls the triple threat endgame.
So this final phase, phase 3, is allegedly a two-pronged attack, happening at the exact same time. Step A is a physical move designed to deliberately crash the price, and step B is a paper move designed to profit from that exact same crash. The idea is that by doing both at once, you create this incredible waterfall of profit. And this is how it's supposed to work. Right at the absolute peak of the frenzy, they strategically dump 100 to 150 million ounces onto the market. That's roughly an entire year's supply deficit hitting all at once. For a market that has heard nothing but scarcity, 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 this sudden flood of metal would be, well, catastrophic. Bids would just evaporate. The price would have nowhere to go but down, and fast. But here's the thing. The collapse isn't a mistake. It's not the end. It's a crucial part of the plan that, according to this theory, opens up not one, not two, but 3 distinct streams of profit.
And this is the so-called triple threat payoff. First, you've got the physical profit. You bought low, you sell at the peak high price, you make a fortune. Simple. Second, you've got the paper profit. You make another fortune on that brand new short position as the price just craters. And third, and this is the real genius of it, the reset. You crash the market, you wash out all the speculators, and you get to start a whole new accumulation phase all over again at the bottom.
So let's just recap the theory we've walked through here. The chaos we see is presented as completely orchestrated, not random at all. A very real supply deficit was allegedly weaponized to create the perfect setup for a trap. The plan profits from the entire cycle, the ride up and the crash down. And the ultimate goal isn't just a one-time score, it's to reset the whole game and stand control for the next round.
When you boil it all down, this theory takes a real, fundamental problem in the silver market, the supply deficit, and frames it as a weapon. It's a pretty compelling story about how market forces could, potentially, be controlled. And as the theory claims, the trap has already been set. The only question left is, when does it spring?